Today, more trouble in the Strait of Hormuz.
The United Arab Emirates says it has intercepted a number of missile strikes from Iran. A large fire has broken out at a petroleum facility in the port city of Fujairah.
As Iran attacks the UAE again, we look ahead to a long, hot summer of energy shortfalls. I'm Kevin Hirten, and this is The Take. Before we continue with today's show, remember to leave us a comment telling us what you think about this episode. We do read them, and it helps us shape future episodes. What do you think about this topic? Are you worried about the energy shortfalls that are coming this summer? And if you're on your favorite podcast app, remember to leave us a 5-star review. It does help the show.
I'm Jim Krane. I'm the Diana Tamari Sabag Fellow for Middle East Energy Studies at Rice University's Baker Institute in Houston, Texas.
So, Jim Krane, it's great to have you on The Take. So, for those who don't know your backstory, you're an author, a former newspaper reporter, and now a leading authority on Middle East energy geopolitics. So, in short, you're a perfect person to talk to as we head into, what could be a very long, hot, and I think turbulent summer. So just to sort of set the scene, the price of oil has really skyrocketed since the war in Iran. The global benchmark price, Brent, hit $126 a barrel last week. So that's about $20 short of the all-time record back in 2008. So I guess, Jim, for starters, how are you feeling about the moment we're in right now? Are we overreacting or underreacting? How does this crisis rank for you?
Well, as far as crises goes, there's a lot more than the oil price in it. So if you look at the oil price side of the crisis, I'd say, we are reacting probably about right. I'm not somebody that likes to second guess oil market traders and, folks that have all that trading algorithms and, supercomputers, et cetera. So, price is probably about right for the moment that we're in because there's so much uncertainty in both directions. President Trump could escalate this thing an hour from now, or he could call it off an hour from now. So I think traders are being cautious, around the oil market. As far as other things outside the oil market, I think we're a bit worse off, right? So LNG, liquefied natural gas, is not flowing out of the Strait of Hormuz. That's a big problem. That's about a fifth of that market, and countries that are dependent on that are having a really hard time. So mostly in Asia, South Asia, and East Asia.
Japan and South Korea are tapping into strategic reserves, while developing countries like Vietnam, Cambodia, Thailand and the Philippines are rationing fuel and closing gas stations. In India, protests have erupted over surging prices and acute shortages.
Fertilizers for crops, so farmers are running short on that. Prices are going up. Other things, sulfur, which is also used in fertilizer. It's used in metals refining. That's also in short supply. Aluminum, other things, petrochemicals. So big crisis. If you lump all those together, it's biggest global economic crisis that I've ever covered.
Yeah. And the 1973 crisis didn't have a lot of those factors. Okay, Jim, I got some news I want to get you to comment on. Fujairah's media office says a large fire broke out at the petroleum industrial site in the Emirate after a drone attack from Iran.
Interesting. So it sounds like things are heating up again if Iran's sending drones across the strait again. That's their main export terminal right now is Fujairah for the United Arab Emirates. So
is that on the kind of the Gulf of Oman side?
It is. It's just outside the strait, so it's still very, very close to Iran. It's uncomfortably close to the Strait of Hormuz.
But there is one? I know that there's a something on the UAE that's on the other side of the strait, and they've been putting a lot of stock in that, saying like, well, we don't really need to go through the Strait of Hormuz because we have this other option. Is that what they attacked here?
That's what we're talking about. Yeah. So there's a second oil export terminal outside the strait at Fujairah. That's right. Yeah. About a 1.5 to 1.8 million barrels a day of capacity through the pipeline, the bypass pipeline in that terminal. So it's not the full capacity of the UAE, of course, right? So their export capacity is more, 3.5 to 4. But it's still a nice chunk.
Wow. Okay. This is
so
big.
If that's lost, if that goes offline, oil prices are going to spike.
Really? I mean, how much higher can they go?
I mean, there's a lot of oil that's being depleted from storage now. So the longer this goes on, the longer the strait stays closed, and as those stock levels are brought down. I mean, oil price is going to have to respond. I mean, that's what it does. It's fewer people are going to travel. Airlines are going to be cutting flights. Countries are going to get involved in rationing. I mean, some of this stuff has already started. It's going to continue, and eventually it's going to start trickling into inflation. Countries are going to try to avoid this because it's inflation's dangerous. It's a trigger for unrest and instability. Fuel price inflation is bad, but food prices are also something we have to worry about, because of the fertilizer and the energy inputs into food. So hopefully, we'll see some compromise some point soon, so this doesn't play out in that way.
Yeah. So amidst all the financial pain, one winner might be renewable energy. And there are a lot of signs.
Albania's vast supply of renewable energy is cushioning its consumers from oil and gas price hikes due to the Iran war. It's a potential model which analysts say could help protect other households from steep price rises and bolster Europe's green energy transition. Countries like Italy, Germany and Greece are gas dependent but are trying to increase capacity for solar power.
The Financial Times reports that investors have pumped more than $3 billion into clean energy ETFs in April. Now, it's the largest monthly inflow in 5 years. The S&P Clean Energy Transition Index is now outpacing oil stocks. I wonder how you interpret this. Is this renewables momentum, or is this just panic money that will evaporate when the stability returns?
Probably a bit of both. I mean, it makes sense. So renewable energy supply chains are just much, much more secure than fuel-based supply chains because renewables don't use any fuel. So when you plug them in and connect them to the grid or connect them to your house, there's no supply chain anymore. They're just getting their energy from, moving air or from sunshine. So, fuel-based systems like those that use oil, gas, and coal need those supply chains to stay connected 24/7, 365. Any hitch and the lights go out. So, and the hitch could be anything from, bad weather to an earthquake or tsunami or war, politics, extortion, undersea mines, or whatever it is, right? So lately, geopolitics has been really fraught, of course, right? So transit risk is the one we're looking at the Strait of Hormuz. So, if you're an importing country dependent on that part of the world, getting tired of the risk, you're getting tired to the damage to your economy, renewables make sense. It looks like a good substitute in the power sector, especially, and for some personal transport. You still need fossil fuel-based backup for longer term backup, but, it's not foolproof. But it is a good substitute, and it's improving all the time.
Yeah. And, there's been a lot of reporting about the European renewables market. Firms like Nordex, Ørsted, Siemens Energy, all seeing double-digit increases. But I do want to ask you about how this crisis might spur renewables push in the global south. And I'm talking especially about countries with close ties to China, which, as you know, is one of the world's largest producers of solar and wind.
There are thousands of wind turbines like these dotted across the country and hundreds more being built every year. Together, they produce about 10% of China's total energy needs.
The global south is supposed to be an area of real growth in the coming decades for the big oil companies. Do you think China could scramble their plans a bit here?
Yeah, I do. I think they already are. China has built an enormous manufacturing capacity in renewables, in batteries, in electric vehicles. And over the past few decades, they've kind of been assembling all the pieces of this through central planning top down. targeting their own market, electricity, as a strategic sector, trying to electrify as much of the economy as possible with some success. They've gained control over mineral supply chains as part of that. And then they've tasked their own manufacturing capacity to increase their capacity in solar panels, wind, batteries, and now EVs. And that stuff is flooding the domestic market. And it turns out there's overcapacity, right? So too much capacity for the Chinese market. The Chinese grid not keeping pace with generation installation there. So, some of this stuff is being curtailed. So they're really looking to the outside world for a new market for all that excess capacity. They need a new source of demand for that. And that is everywhere else. So the U.S. and the EU have set up some tariffs because they view this as dumping, this cheap stuff. So now that kit is all flowing to the developing world, or a lot of it is. These are exactly as you said, the countries that were supposed to be the growth markets for oil and gas. And now we've got all this cheap renewables flowing there. I mean, Pakistan last year, 17 gigawatts of solar panels in a country whose entire grid was only 47 gigawatts. It's like a third of their total installed capacity.
A decentralized solar boom, driven largely by households, farmers, and businesses, has helped reduce dependency on fuel import. According to a study published last month, the uptake of solar around 2018 has helped Pakistan avoid more than $12 billion in oil and gas imports up to February this year. At projected market prices, it could save a further $6.3 billion by the end of this year.
So, yeah, it's a big story.
That is a big story. I mean, China has increased supply or extra supply, and now there's suddenly this huge demand. Let's move to some of this OPEC drama. The United Arab Emirates has pulled out of the oil-producing bloc.
The UAE has released a statement saying this decision aligns with the UAE's long-term strategic economic vision and the development of its energy sector. It's also driven by national interests and the country's commitment to actively contributing to meeting the urgent needs of the markets.
And there's really a lot to unpack here, and this is a little bit technical. So can you tell us kind of what OPEC is, why this happened, why UAE pulled out, and really how significant it is for OPEC to lose the UAE, which is its third largest producer?
Yeah, sure. Well, OPEC, of course, is the oil producing cartel, started in 1960 in Baghdad. UAE was one of its earliest members, right? The UAE took part in the Arab oil embargo of 1973, sort of when the rest of the world really found out about OPEC, caused a lot of pain back then.
The Middle East war produced developments all over the world today. The oil-producing countries of the Arab world decided to use their oil as a political weapon. They will reduce oil production by 5% a month until the Israelis withdraw from occupied territories.
Over the years, OPEC has been more of a source of stability in oil markets rather than disrupting a factor. And then when shale oil kicked off here in the United States, around 2007, U.S. oil production ramped up so quickly that OPEC began to lose some of its market power. And they needed to bring in another big producer to reestablish it. And that was Russia. So in 2016, OPEC Plus was formed. Russia was pulled in. And now you have this key partner of Saudi Arabia, United Arab Emirates, that has pulled out, right? So this is a rare oil producer that has lots of spare production capacity right now that it can bring online, under normal circumstances when the strait's open. So it's a big deal for OPEC. I mean, prior to the UAE leaving, all the other, quitting countries were pretty minor producers, didn't really affect the market power of OPEC. This is different, right? UAE was not a great fit for the cartel. So some colleagues and I wrote about this. UAE has had the largest, most intrusive quota, so the most amount of production offline of any OPEC country by far in recent years. It's a wealthy country. It's got a more diverse economy. So different than the other countries, which are more kind of old line petro states.
So when you say that quota differential, you mean that UAE wants to produce like 5 million barrels a day, but the quota that OPEC puts on its countries means it can only do, 3 million.
Yeah, that's exactly right. So it's, UAE over the past few years has been ramping up investment, moving from 3 to 5 million barrels a day, but its quota has still been below 3, or now it's, just over 3. So really leaving a lot of money on the table, a lot of production idled, that has spent billions of dollars investing in. So big incentive to move away, but it also has a much more diversified economy. So it's not as affected by swings, volatility in the oil market anymore.
Okay, well, there's still a lot of questions surrounding this. I mean, for UAE, they could just ignore the quotas. I think Kazakhstan has quotas that it just blasts through. There's a lot of speculation that this move by the UAE was at the very least highly encouraged by the United States. Why would the U.S. want the UAE out of OPEC?
Yeah, so the UAE actually has been blowing through its quotas. It's been kind of a perennial quota cheater for a while.
Really?
But but not at the scale of the spare capacity that it has, right? So on closer relations with the U.S. and the U.S. Encouragement, so I think that is part of this, right? So, I think, Abu Dhabi and the UAE overall, they have bigger ambitions on the global stage. I think they see themselves being held back by being a member of this producers cartel that, concentrates on, adjusting prices of a commodity that, I think they find that a little bit onerous.
Let me ask you this, what is the advantage to a member state of OPEC? And what do you think the consequences will be on the international oil markets of the UAE pulling out?
So for a small country, if you think about Equatorial Guinea or, one of, the smaller countries, they don't have much clout within the cartel, right? So they're not going to swing, a decision one way or another in their behalf, but it gives them this sort of imprimatur of being sort of a mover and a shaker on the global stage. They get some geopolitical stature out of this. They get an inside line on OPEC oil market strategy. And when their minister or their president is out on the international stage, people tend to listen to them a bit more because they're within OPEC and they're privy to a lot of interesting discussions and decision making.
And the second question is what are the consequences now? And I think the consequence is that there's going to be more volatility in the oil market. So why is more volatility a bad thing for the oil market?
Yeah, I mean, volatility, is horrible for countries that have to deal with it because, oil, and if you think about oil as a transportation service, everything is transported, right? We bring stuff in and out of our countries and move it across the national boundaries and within our countries all the time. That takes oil to do that. So it drives the prices of everything up. It kind of pushes into inflation. And inflation is a key trigger for anti-government sentiment, right? So if prices are going up and your income is going down relative to prices, people start to turn on the government pretty quickly. So this is something that can trigger unrest, a lot of anti-government sentiment, and the incumbent head of state might get thrown out at the next election.
Yeah, I mean, so, okay, that's exactly the sentiment we can sort of end on. I mean, the question is when, right? I remember hearing that by mid-April, the rubber was going to meet the road, that we'd start seeing those shortages. And look, I don't want to underplay like how much people are struggling out there, but it's now May. The world is still relatively normal. But I mean, is all that oil that left before the war, is that all going to start getting used up? I mean, is there going to be I heard somebody describe this as this is a problem of molecules. At what point are we just out of enough molecules and we do start seeing these jet fuel shortages, empty gas pumps, fuel rationing?
It's kind of a country by country thing. So in some places it's happening already. I mean, countries that have huge amounts of oil and storage are running those stocks down, but they still have some kind of a comfort level. So, Japan is probably the one that has the biggest comfort level, right? They had more than a year's worth of storage in their private and in their public stocks. China also has a, really large cushion. So more than 1 billion barrels of oil in storage when the conflict kicked off. U.S., our strategic petroleum reserve was half empty when the war started. So we're not in as good a position in terms of strategic stocks, but we're a big producer, right? So, but countries that don't produce and that don't have strategic stocks or not enough strategic stocks are in a tight spot, and it's going to get tighter. So think about Pakistan, think about Bangladesh, landlocked countries like Nepal, the Philippines is one been hearing a lot about lately. They're at varying degrees of emergency already.
Scary stuff going into what's going to be a hot and long summer. Jim Krane, thank you for coming on The Take today.
Indeed. Yeah. Thanks for having me. Appreciate it.